All right, welcome back for valuation of medium-sized companies. We're going to talk about medium-sized companies and to evaluate them by using the firm valuation method. You find it all back in my book, Business Valuation. Remember, you have two methods. You have the equity valuation methods, valuating the value of the shares straight away, and secondly, an entity valuation method, which is in fact working with the invested capital and is consequently starting from the free cash flow. And it's this valuation method I'm going to explain you today. Now, look very well to the formula, free cash flow divided by WACC. Let's have a look to the first part. What is free cash flow? So if we are calculating the entity value of the company, we are calculating what we call the firm value, and we are calculating in fact the value of the invested capital of the company, the capital employed of the company. That means the value of owner's equity and interest-bearing debt holders. So consequently, if you want to know the value of the shares, once you have calculated the value of everything of the entity, you always have to deduct the financial debts, the interest-bearing financial debts, to get the value of the shares. Now, what is the difference between free cash flow? Free cash flow, as you're working with the invested capital, and as you know, the invested capital is the equity plus the interest-bearing debt holders, you will always start with the EBIT. And you will deduct the taxes from the EBIT, and then you will deduct your average investments, plus your depreciations, plus minus your mutation and working capital requirement. If you're calculating an equity cash flow, you will start with your net income after tax. So it's a huge difference in the way of calculating. This one needs less assumptions, and that's the reason why in a lot of cases the entity or firm value is used to calculate the value of the shares. Now, how do we calculate the free cash flow? As we know, it's a firm value, it's an entity valuation method. You always start with earnings before interest and taxes. Now, very important, minus taxes, it is minus the adjusted tax. And that means it's not a marginal tax. You're deducting here the taxes you have been budgeting in the equity cash flow calculation. That means the taxes you really think you're going to pay in the future. So it's not a marginal tax rate you're using here. Once you have deducted your taxes, do add your depreciations, do add your provisions, but normally you don't take in the amounts written off concerning customers or in amounts written off concerning inventories, because they will be taken into account in the mutation of the working capital requirement. Once you have done this, and you have taken into account and into the calculation the mutation of the working capital requirement, the only thing you have to do is to deduct the average recurrent investments the company has to do to come to the free cash flow you need for your firm valuation. I bring you back in the next video to a real example of how we're going to calculate the firm value based on free cash flow. See you back.